The moment your paycheck hits, the money begins a rapid migration. A portion is routed to a pension fund, another goes towards insurance premiums, and the remainder settles into a commercial checking account. For most people, that bank balance feels static, a safe digital number resting in a vault until it's needed for groceries or rent. But the vault is a facade. In reality, that cash is immediately pulled into an invisible, hyperactive web of global finance. A checking account functions as the primary intake valve for a trillion-dollar machine designed to move, multiply, and leverage cash on a global scale. The engineers at the top of this system are the central banks, such as the Federal Reserve. They create the money and set the rules that every other financial institution must follow. They regulate the economy by adjusting two primary variables: the total supply of money in circulation and the interest rates required to borrow it. Through quantitative easing, the central bank buys government bonds, flooding the system with cash and lowering borrowing costs. To fight inflation, they use quantitative tightening. Selling bonds back into the market pulls cash out of the economy, parking it so it can't drive up prices. This makes borrowing expensive. When interest rates rise, the brakes slam on economic growth, slowing down everything from corporate expansion to home mortgages. By adjusting these two levers, central banks establish the baseline speed for every other player in the financial pipeline. Next are the commercial banks, the workhorses that pull idle cash from savers and immediately loan it out to people and businesses that need capital to grow. This diagram shows how banks expand the money supply. Because reserve rates in major economies are now 0%, banks can issue loans for many times the amount they actually hold in deposits, effectively creating new money through the lending process. Pension funds also aggregate massive amounts of wealth, controlling over $60 trillion worldwide. To ensure they can pay out future retirees, these funds must hit aggressive annual returns of 6 to 7%. To find that yield, they diversify into massive physical assets, purchasing landmarks like the Hudson Yards complex in New York. Insurance companies operate on a similar scale. They collect monthly premiums from millions of customers to spread out risk, then quietly recycle that cash into global markets while waiting for claims to be filed. Because these aggregators manage such vast pools of capital, they eventually run out of safe places to park it. This forces them to push your money further down the pipeline toward high-risk investors. Investment banks act as matchmakers. They build bridges between the aggregators' cash and corporate targets through public stock offerings and multi-billion-dollar mergers. Once the capital is connected, hedge funds take the lead. They use extreme leverage to make unregulated, high-stakes bets on everything from currency fluctuations to election results. Elite hedge funds, like those managed by Jim Simons, charge high fees to manage this money, typically taking 2% of the total assets and 20% of all profits. These managers aim to consistently outperform traditional benchmarks, often delivering annual returns that dwarf the historical averages of legendary investors like Warren Buffett. Private equity firms take a different approach, acting as corporate house flippers. They raise billions to buy companies, restructure them, and then flip them for a profit within a few years. This animation shows the mechanics of a leveraged buyout. The private equity firm uses a small amount of its own cash and borrows the rest, but they dump the crushing weight of that debt directly onto the purchased company's books. Finally, venture capitalists like Peter Thiel invest capital into the absolute highest risk startups. They expect 90% of their bets to fail, knowing that a single massive return will cover the losses for their entire portfolio. These high-stakes gambles by hedge funds, private equity, and venture capital are ultimately bankrolled by the safe capital held by pension funds and commercial banks. This map shows the full circuit: central banks setting the baseline speed, while aggregators pool the fuel for the matchmakers and deployers downstream. A single dollar deposited into a checking account can travel through this network in days, eventually providing the liquidity for a high-risk startup bet on the other side of the world. This connection means the safe money held by aggregators is directly exposed. When a high-risk bet fails at the bottom of the chain, the losses travel back up the pipeline, hitting the balance sheets of the pension funds and banks that provided the initial capital. Global finance is not an isolated game played by billionaires behind closed doors. Every paycheck earned, every loan signed, and every premium paid fuels this interconnected web, keeping the global economy in motion.